Hey, this is a good eBay ad. French military rifles for sale, hardly used, only dropped once. Oh, but I see it's time for our video to start. I'm Dan Mitchell with the Cato Institute, and I'm here with you today to narrate this brief video from the Center for Freedom and Prosperity on why America needs a lower corporate income tax rate. Let's start with an economics lesson, but I promise this will be short. Don't turn off the film. Every economic theory, even Marxism, agrees that a major cause of long-run growth and higher living standards is saving and investment, what economists call capital formation. This is the well-established principle that you set aside some of today's income to finance tomorrow's growth. But the Internal Revenue Code treats savers and investors as if they were criminals. The chart you're looking at now shows how the current tax code is biased against capital formation. Between the capital gains tax, the corporate income tax, the personal income tax, and the death tax, a single dollar of income can be taxed as many as 4 times. You don't have to be a wild-eyed supply-sider to understand that this is going to discourage saving and investment. What's funny, or actually not so funny, is that politicians actually understand a bit of economics, at least when it serves their self-interest. They're always talking about how we need higher cigarette taxes to discourage people from smoking. Now, I don't think it's the government's job to control our private lives, but the politicians are right from an economic perspective. The more you tax of something, the less you get of it. So why then doesn't the crowd in Washington understand that high taxes on saving and investment are bad for economic growth? The whole issue of the corporate income tax is especially frustrating. Some politicians say it's better to tax corporations than people. Are they smoking crack? Corporations collect taxes, but people are the ones who bear the cost. The corporate tax is a burden on investors. And that means you, if you have an IRA, a 401k, a mutual fund, or some other investment account. The corporate tax is a burden on consumers. And that, once again, means you, at least if you ever buy anything. And last but certainly not least, the corporate tax is a burden on workers. And that, once again, means you, at least unless you're mooching off the taxpayers. Let's shift from economics and look at some real-world consequences. Everyone understands that we now live in a globalized economy, and whether we like it or not, jobs and investment can cross national borders. The key question is whether we want the factories being built and the jobs being created here in America, or do we think it's okay for jobs and investment to go to India, Ireland, China, Brazil, or numerous other nations hungry for more prosperity? This brings us, finally, to the topic of today's video. America's corporate tax rate is too high. The federal government imposes a 35% tax rate on corporate income, but that's only part of the story. States also impose corporate taxes, pushing the nationwide corporate tax rate to nearly 40%. This high tax rate would be a problem even if we were the only nation in the world. In a competitive global economy, though, this high tax rate is a huge self-inflicted wound to U.S. competitiveness. Depending on methodology, America has either the highest or the second highest corporate tax rate in the developed world. All European nations, even welfare states like France and Germany, have lower corporate tax rates than America. That's downright embarrassing. Even more discouraging, other nations are being smart. They're lowering their corporate tax rates. Just since the mid-1990s, 24 European Union nations have cut their corporate rates. Indeed, the average corporate tax rate in the EU has fallen from 38% in 1996 to 24% this year. America used to face a slight competitive disadvantage, but as the chart shows, we have fallen way behind. Our corporate tax rate is nearly 16 percentage points higher than the European average. And the tax cutting is still going on, at least every place other than America. Germany's corporate tax rate is falling by 9 percentage points next year. The new French president says he's going to cut the corporate rate. Spain and England are in the process of lowering rates. And there are plenty of places all around the world, of course, that already have very low corporate rates, including Hong Kong, Ireland, Singapore, Estonia, Slovakia. It seems the rest of the world realizes that low corporate tax rates are necessary for economic growth. Ireland's a great example. Back when its corporate tax rate was 50%, Ireland was an economic basket case. Unemployment reached 17%, the economy was stagnant, and the biggest export was people seeking a better life. But then Irish leaders decided to adopt a new approach. Combined with other free market reforms, the Irish corporate tax rate was slashed from 50% to 12.5%. As a result, the former sick man of Europe is now the Celtic tiger. Unemployment has almost disappeared, and economic growth has been amazing, causing living standards to double in just 10 years. And what's most impressive, Ireland is now the second richest country in the European Union, behind only Luxembourg, which is a special case because it's a small tax haven. Some politicians say we can't afford a lower corporate tax rate, but the real question is whether we can afford to keep the current system that makes America less competitive. Besides, the politicians are wrong to assume that a lower rate means they get less money to spend. Now, just between me and you, it's a good idea to deprive them of money, sort of like helping an alcoholic by hiding the keys to the liquor cabinet, but sticking to the main point, the international evidence shows that lower corporate tax rates don't necessarily mean lower corporate tax revenue. In Ireland, for instance, the old corporate tax with the high rate collected revenues totaling less than 2% of GDP, or economic output. But now that the rate has been slashed from 50% to 12.5%, the new system is collecting more than 3% of GDP. And what's really impressive about that number is that GDP is more than twice as high today. So the government is getting a much bigger slice of a much bigger pie. Some of you may think that I'm deliberately picking the one country that makes my point. And you know what? It's good for you to be suspicious. After all, I do work in Washington. So let's look at some other sources of evidence. The World Bank is hardly a bastion of free market thinking. So it is big news that the international bureaucracy just published a study stating that high tax rates do not always lead to high tax revenues. Between 1982 and 1999, the average corporate income tax rate worldwide fell from 46% to 33%, while corporate income tax collections rose from 2.1% to 2.4% of national income. The bank study goes on to say, a better way to meet revenue targets is to encourage tax compliance by keeping rates moderate. Even the European Commission, a bureaucracy that's infamous for trying to harmonize corporate tax rates at high levels, recently confessed that it is striking that the declining corporate income tax rate have not resulted so far in marked reductions in tax revenue, with both the Euro area and EU 25 average actually increasing slightly from the 1995 level. I'll be the first to admit that none of this necessarily proves that a lower corporate tax rate in America will lead to more tax revenue, but it certainly suggests that politicians shouldn't lose much sleep worrying about less money coming to Washington. But you know what? Who cares what the politicians think? This is an issue about making America more competitive. It's about getting more investment so that American workers can earn bigger paychecks. We need to lower our corporate tax rate. You know, we generally kick Europe's rear end when it comes to most measures of competitiveness. Our personal income tax rates are lower, our payroll tax rates are lower, and we don't have a national sales tax like the European value-added tax, which is a big reason why the overall burden of government is lower in America. But we're losing to the Europeans in the race to implement a more competitive tax system. Our tax rate is nearly 40%, and their average tax rate is down to 24%, and it's still dropping. And let's not forget China and India, both of which have lower corporate tax rates than America. You all have been very patient. I've been going on for a lot longer than I thought, but that just shows how important it is to lower the corporate tax rate. So I want to close by asking all of you a favor. No, not for money. You can put your wallets away. Instead, please send this video to a few people you know. We need to educate the American people on the importance of a lower corporate tax rate. The longer the politicians wait, the longer they keep our tax rate high, that means more jobs, more investment won't be here in America. We can't afford to have the geese that lay the golden eggs to fly away. I'm Dan Mitchell, and on behalf of the Center for Freedom and Prosperity, thank you for listening.